All right, looks like it's that time. To call to order the San Lorenzo Valley Water District Board meeting on March 19th, 2026. Leah, would you do the honors?
President Russ.
Here.
Director Smalley.
Here.
Director Holmes.
Here.
We have a quorum.
Okay. All right. Any changes to the closed agenda?
No changes.
No changes. Okay. And I get ask anyone,
Nobody with their hand up.
no one's their hand up for the closed session? Okay, then we shall adjourn to the closed session.
Excuse me, is the audio on? Is something muted?
Yes, you were muted.
There we go. Okay. Hi everyone. I can hear you now.
Hi, Gage.
All right. Do I have to redo that, Gage?
Yeah.
Well, I didn't hear anything before you turned that on.
We're introducing Ken to introduce the debt financing scenario, so I'm
Perfect.
not going
Thank
to
you.
go over everything I just said, but all right, 1 second. 1 second, Ken.
No problem. Did other remote people not hear that?
They didn't hear it, but they didn't put their hand up.
You may want to
Okay.
reiterate that, for any public comment that may be, because if they didn't hear that.
Okay. Are any of the public that are remote, apparently you weren't able to hear Ken's the introduction of the background of what Ken's going to be presenting tonight. Did any of you have any questions about that introduction, that backstory?
Or any public comment not on the agenda.
Or, or any public comment that's not on the agenda, because you might have been muted. There's one.
Cynthia, not yet. Cynthia Denzel.
Okay. Cynthia, please. And Ken, little delay.
I did not hear anything until just now when you unmuted it.
So did you want to hear
Yeah.
that introduction?
Did you want to hear the introduction by our general manager, Jason Lillian?
Please.
Okay. Well, I think so. Jason's going to go through it again. Okay, here we go.
I'll make it a little more brief. So to reiterate, the district's current 5-year capital improvement plan is $55.3 million in capital improvements. It's $25.1 million in fiscal years 26 and 27, and 30.2 in fiscal years 28 through 30. That includes taking out a COP of $16.5 million this year. On December 4th, the district's municipal advisor, Ken Deeger of Del Rios Advisors LLC, presented 9 financing scenarios to the board. They, during that discussion, there was concerns for backloaded principal. Mr. Becker returned on February 5th with an updated recommendations for a 24-year wrap debt service structure that would achieve a level aggregate debt service through fiscal year 2050. Subsequent to that, an ad hoc finance committee group met further to discuss and brought those findings back to the board on March 5th. And Ken is here to present the board the final presentation. So, Ken.
So bring the presentation up.
Yep, bring that right now.
Perfect. All right, next slide. So Mr. Lillian did go over the first part of this, so I won't reiterate it. I did want to update the board. I think I mentioned when I was at the Zoom meeting on March 5th, the financing team did apply for a rating from Standard & Poor's S&P. The district did receive an A rating with a stable outlook. So the district board should be very proud of everything you've done. I believe Mr. Lillian forwarded you guys all the rating report from that. The financing team also applied for bond insurance and a surety. And a surety is insurance policy that replaces a cash-funded reserve fund. So part of municipal bonds generally for A-rated or lower ratings, you would have to fund 1 year of debt service essentially as cash and hold it with the trustee. By not having to fund that, it keeps your bond issue size down and helps to increase your cash flow. Clearly, if you were to cash fund a reserve fund, you could earn interest on it, but with the interest rate environment moving up and down kind of crazy as it is, you take the chance you could lose money on it. It's better not to have to fund it all. This surety policy, in essence, replaces that reserve fund. So we did receive a bid from Assured Guaranty. It was a very favorable bid. We did go to Build America Mutual, the other bond insurer that participates in this. They declined to bid based on environmental issues, primarily seismic and fire risk, that they declined. So we were very fortunate. So when I drafted the staff report, it was before we got the final rating. It was before the insurance. So I put in both scenarios, assuming we were going to do a rated transaction with a cash reserve fund and assuming that we would secure the insurance with the surety. So I'm very happy to report that we did get the surety. The benefit of insurance is it raises the district's rating from A. The bond rating goes to AA based on the rating of the insurer. So that promotes lower interest rates. However, what we do need to do is to quantify that there is a benefit of paying the insurance premium so that the lower interest rates more than offset the cost of the insurance premium. And I'll show you that here in just a minute. Next slide. Again, to reiterate, this is the structure of the debt as proposed. Here's your 2026 COPS, and here's your total debt service, coming out to about $67.6 million over the remaining life. You can see that all of the debt matures by the year 2050. So this is consistent with what the ad hoc findings were. So it's a 24-year wrapped level debt service aggregate basis. And then it's my understanding that the recommendation from the ad hoc committee to the board was that future series would most likely be 30-year terms. And that's consistent. So the numbers I'm going to show you tonight also include future series with a 30-year amortization, just to be consistent with the findings.
And Ken, just to give you the ability, if you don't want any questions as you're going, we can hold off, or if you're
I'm
okay with
happy to do
questions.
either way. If you do have questions while we're on a particular
Okay,
subject,
so-
please ask.
Now that we've got a AA rating, I'm assuming that reduces our effective interest costs a
It
little bit?
does. So if
Okay.
the one that's in the staff report was the rated and cash funded reserve fund, your total aggregate debt service was around 70 million.
Right, I did
So
see
the
that.
benefit of the insurance and surety is a much lower annual debt service amount.
Okay, but I'm sorry, this particular table says A rated as opposed to AA rated.
It is an A rated, it's A rated underlying rating with bond insurance and a reserve
Ah,
fund surety. So the
okay.
A rated refers to the district.
Just, okay,
Yeah,
got it.
That's a good question.
No, thank you.
Yeah.
Okay. I was hoping that we were saving a little more.
Yeah.
Okay.
Well, we are saving, I'll show you a little bit.
Yeah.
Next slide. So I went ahead and just graphed the debt service so the board could see sort of what the impact of that is. You can see here from 2050 to 2051, the debt service essentially drops off. So I tried to meet what the board's recommendations were at the last meeting. Next slide.
And just for the community, that isn't actually what's going to happen. You're gonna have loans from now until forever, basically, so.
Correct. This is only just reflective of
This
the
is just
issuance,
like the-
including the Series 26 where we're leveling out the debt.
Right.
Yeah,
Just want to make that clear for everybody.
that's perfect. Yep, you're absolutely correct. Next slide. So what I did is I put together an analysis here that shows the benefit of, so this first scenario is the A category rating with a cash funded reserve fund. That's sort of the base case, and that was one of the ones I drafted up in the staff report. And then I assumed an A category rating with insurance, but with a cash funded reserve fund. So I'm looking at what is the true economic benefit of just purchasing the insurance, forgetting about the surety policy, which lowers the debt service considerably. The benefits are about $174,000 of lower debt service over the 24-year term, or about $7,200 a year. So it's not huge. The insurance companies are very good at pricing it based upon the underlying rating, right? But they do know that there is a benefit to doing that, and we have been conservative numbers, so we expect the insurance actually may be more beneficial. And then I added to that, what's the impact of doing the surety? And you can see that the debt service drops from about 70.5 million down to 67.6 million. That was in that previous table. So the surety clearly brings down the issue size. I also think one of the board members asked the question, how come we're going from 17 point something million down to 16? That's the difference of funding 1.8 million in a reserve fund. If we don't have to fund that, your issue size comes down considerably.
And I guess you could also argue that 174,000, since that's total debt service over 24 years, on a present value basis, it's
100.
maybe 100, maybe half that. Yeah. And
No,
we-
it's not a big number.
Yeah, it's not a big number, right?
We
So,
just have to, I think the benefit of the insurance, we have to quantify if there's a benefit to just purchasing the insurance, but clearly without the insurance, we couldn't get the surety. That's where the real true cash flow benefit, in my opinion, comes from.
And actually, I think we did this in 2019.
Hmm.
I think we had exactly the same situation where we had an A,
and got
and then we got, because I'm pretty sure we
We
got,
did not have an underlying rating. The bonds were simply insured.
oh, okay.
We did confirm that again today.
Because when I saw the agreement, it looked like it had AA listed in the,
It does because that's the rating of the insurer. So the underwriter that you worked with simply went to the bond insurance. They don't really do that anymore. They require underlying rating to help price their policies. But years ago, you were able to just go to the insurance company and bypass the rating process. You can't do that.
okay. And did we get a surety back then as well?
Do you recall? By the way, this is Nikki Coleman from Oppenheimer and Company. She's here to answer questions as well today. She's the underwriter.
Because I know we did something to lower
Yeah,
overall
I
costs.
don't recall if it had a surety, but we can look that up.
Sure, no problem.
So anyway, I quantified that there is a benefit, even though it's slight, there is still a benefit to the insurance.
And have a surety.
It did have a surety.
That's
Good
what,
memory.
yeah, okay, yeah.
But the real benefit is with the insurance, the combination of that with the surety makes it really worthwhile, I believe, for the district. Next slide. So this table is going to be a little hard for you to see, but I updated the pro forma based on the numbers, and I'll just point out a couple things. Your low cash position, which is pretty consistent with the pro formas, is around fiscal year 2030. This assumes that we're going to issue bonds in 2028. But one thing I want to point out is that we are planning that if you receive the FEMA reimbursements, you may be able to bypass another series of bonds in 28 altogether. That is still subject to timing, right, of when those receipts come in. And your debt service coverage, because the numbers improved, Heather was very conservative with her projections, and when the actual numbers came in, we had significantly more revenue. So your debt service coverage around 190, and then I did assume a $6 million issue for that third series out in 2031, kind of consistent with the pro forma. So you've got very strong debt service coverage, very good cash position, and this assumes that under this scenario, you put $18 million towards your CIP in 2028 to keep the bond issuance size down. Again, all subject to your FEMA reimbursement. So the plan of finance at least accounts for the fact that you hopefully get those dollars and won't need to do another financing. Next slide.
Before we move on from that, the number that we had for available for debt service in the model that we are working on was 6.6 million. And you're showing here 5.8.
Well, yeah.
Am I missing?
No, this is Ken's model, the one that we were.
I didn't have any access once you guys took the model over. I didn't have any access.
So they're different models and we were doing our own internal.
Okay, yeah, because right now, if you just do we've got 7 months of, and just do a straight line interpolation, we're at 6.2 million for the year. So I know that that's not a huge difference, 5-6%, but you don't want that to be what happens going forward, right? So it's really important that we make sure we close on that number for the year.
Well,
Get it
yeah,
going,
and,
right?
and
Not
in the
just-
model that Ken's using, he's continuing our water revenues at 3%. We've got different
Yeah,
numbers,
different numbers.
all of
Yeah,
that. So
Clearly,
they are different. Yeah.
But
So,
interestingly enough, we all kind of ended up in the same place, right? So that
We
was
did.
that's really good at the end of the day.
Yes.
So, any more questions on this?
Can we share the model back with you?
Yeah, you're welcome to share it back to me. Yeah.
Yeah, for future,
Yeah,
for
absolutely.
future use.
Next slide. So I just wanted to share you some of the specifics. Now, I know that there were some questions from the board regarding why some of the documents have blanks in them, and that's required because we have not sold the bonds yet. Assuming we receive approval tonight, and Ms. Ballman and I were talking about schedule today, assuming that we get approval from the board tonight, we have a due diligence call with district staff next week. The underwriters have to go through this due diligence process and a series of questions. We're hoping to maybe print the official statement or post it online at the end of next week, shooting for either the first, second, or first, second, or fourth week of April to price. And again, we're working around sort of heavy refunding schedules, what else is showing up in the municipal market. This, what we have to be careful of is things like really large transactions coming from like the state of California, maybe selling a $3 billion GO bond. We don't want to be out at the same time as somebody who takes up all the oxygen in the market. And we clearly want to work around Fed meetings. And of course,
We
news
just had
is
one,
crazy right now, right?
and
So,
we didn't get a reduction.
we did not.
It's-
So this is an estimate based on a scale from a couple of days ago. This is just to give you an idea of what it looks like. The market is extremely volatile right now. And I will tell you that since the war started, the muni market's gone up between 15 and 25 to 30 basis points. The treasury market's gone up even more. So there's a lot of fear of inflation out there. And because the muni market is kind of tied to the treasury market, you've seen a lot of volatility. We're hoping things calm down. There's also a lot of refunding volume coming in April. So we want to work around some of that volume in the marketplace. So that's why I'm giving you just an estimate, but we should be able to close either by the end of April or no later than the second week of May, depending on when we actually sell the bonds.
I am curious what's the reference that is used for our kind of size, our rating? How do you determine that day? What as an underwriter, how do you determine that price?
So there is a
Okay.
standard pure AAA index that is published every morning and then finalized in the afternoon,
Okay.
called the Municipal Market Data Scale. It's a pure AAA scale for the municipal market. So if you were a pure AAA credit, every bond issue sold in the marketplace is referenced off of that. So your transaction as an A-rated underlying with AA insurance will have a spread to that MMD, so it'll be slightly higher yielding. And what you do is you look at other comparable deals in the marketplace, other utility enterprise deals, similar size, similar rating with insurance, and you do what's called a comparison against those deals to make sure that your spreads are in line with what other deals have been done in the marketplace. And that's part of the pre-pricing and pricing process that we will do either the first, second, or last week of April.
Okay. And that spread for compared to AAA and where we are, is that 100 basis points?
Oh, no, it's pretty narrow.
Very narrow. Oh, 10 or 20?
Yeah, well, it could start in the earlier part of the scale, the shorter maturities, it could start with 5 or 6 basis points
Wow,
above the
wow.
MMD.
Okay.
It could go out to 30 basis points
at the
35.
rear end.
on the rear end.
Oh,
That's
interesting.
a
Okay.
24-year term.
Okay.
So,
Yeah.
that's a range as of today. We underwrote for Town of Windsor wastewater transaction 37 million, so a little bit larger than this one in size does matter. A lot of the institutions and funds, FMA accounts want to know that they're gonna get bonds if they put the research into the project.
Right,
So
right.
typically a little smaller size might garner a little higher interest rate, a little wider spread to get the investors interested, but we'll see how the market is.
Okay. And so I'm assuming from a marketing point of view, the reason that this is priced at exactly 5%, did you want it to come in at a premium? Was that?
Hold that thought.
Oh, okay, all right.
Hold that, that's a good thought. Yeah,
Okay.
we'll talk about that.
All right, yeah.
So I just wanted to share with you the sources and uses. These bonds are being assumed with being sold at a premium, and part of the reason, and that's a very good observation, but in a rising interest rate environment, investors like the higher coupon. So even though we're selling it with a 5% coupon, you'll notice that the yields are considerably less than 5%. That's a premium scale because in a rising interest rate environment, that bond has less volatility. And that's why investors in this sort of environment like the higher coupons. And that's particularly with the institutions, like the Franklin funds, the Benham funds, the big institutions that buy these term bonds. They demand that or they won't buy it.
Okay.
So we've got 16.145 million. Here's the cost of issuance. We'll talk about that in just a minute. The underwriter's discount paid to Oppenheimer, and here's your insurance and surety premiums for Assured Guarantee. And you can see there's no reserve fund being associated here. Next slide. Here's your cost of issuance, consistent with what I've shared with the previous board presentations. The only difference is that in one of the transactions that you entered into before, it does require a CPA to verify the debt service coverage. That fee is actually going to be $2,500. I talked to them today, but when I did the budget, I put in $5 for now. That's really the only difference from previous budgets that you've seen, only because we have to go through that extra step to verify debt service coverage.
Is that a one-time?
Yes.
One time.
Yep. As part of the transaction, they have to send out a report that would be part of the closing transcript. It's a one-time fee.
And then on an annual basis, would we pay the $3,000 to the trustee every year?
Yes.
Okay, over the 24.
Over the 24 years, correct. And that's very consistent. I'll talk a little bit about what the trustee does in just a minute.
Okay. And is that the only annual cost?
Other than your annual continuing disclosure, which you have to provide to Emma, and that's an ongoing cost to prepare those reports and to file those.
Okay. And is there an estimate about kind of what range that might be?
Sheree, do you know what you guys pay now? It's probably $1,200, $1,500.
I was gonna say 18, but.
Okay. All right. It's okay.
Yeah.
That just went a ballpark. Thank you.
Yeah.
Okay.
Next slide. So again, this is the preliminary scale based on the underwriting desk and what they've seen in the marketplace. We've got our 5% coupons, and here's the yields ranging from 2.4% in 2027 out to 4.74% in 2049. That's a 9/149 maturity that falls in fiscal year 2050. So there's your 24-year wrap. And again, this is what we believe is a good estimate. I think there's a little bit of spread in here. I think we can improve on this, but this market is very volatile. But I just wanted to give you guys an idea. And you can see that we have principal amortizing every year. You can see it kind of bumps up when some of the other obligations in your portfolio mature. The only one that we don't have is 9/127. I think you guys discovered what I found long ago, that's kind of your pinch point in 2027. Next slide.
Well, I'm sorry. And are there, you were referring to term bond 1, term bond 2.
Right.
It's broken up into groups. What's the reason for that?
Okay, so these are serial bonds, and these would be sold to individual investors or professionally managed accounts who manage portfolios for individual investors.
For one,
because they're
up to-
smaller blocks, right? So you might have a mom and pop who buy 15 bonds a year and so on. So it can be broken up into pieces. So these are smaller, and these are called serial bonds because they're sold individually. What you do here, this is called a term bond. It's all at the same price and yield. And these are sold to institutions. They're going to receive a principal payment on 9/142, but it's a single bond in a larger block. And the institutions like blocks above 5 million.
Okay. Thank you.
Next slide. And again, this just shows the portfolio debt service. The one thing that's different between the previous is the 26 isn't in here, but this just kind of shows you what the debt service looks like on the proposed bond. Again, wrapping around, trying to be consistent with what the board's direction was. Last slide. So I just wanted to talk a little briefly about what the documents that you saw, because it is quite a package. So the installment sale agreement, we did go to the CSTA Finance Corp, the California Special District Association. They approved the financing, under which the corporation agrees to provide upfront financing. So essentially the bonds, they've agreed to provide you the bond proceeds in exchange for you making installment payments from the district to the corporation, which in essence kind of bypasses the corporation and goes to the trustee who handles the debt service payments on behalf of bondholders. You might have 35, 50, 100 bondholders, right? You don't know until you actually sell the bond. So there's no way that the district could pay those people directly. We have to use a trustee. The trust agreement is between the corporation, the district, and US Bank as corporate trustee. They agree to execute and deliver certificates, governs all the terms and conditions of the certificates, creates all the accounts, describes the flow of funds, how the payments work, governs any events of default, governs the dues trustee vis-a-vis the district and the owners. They basically represent the owners in the event of a distress situation. So the trustee plays a very important role. The primary role is they receive the payments directly from the district, the debt service payments, and then they forward it off to DTC, who will ultimately send it off to all the various bondholders. Because you might have a 5,000 bondholder here and 100,000, so there's no way that it's not like you're paying directly to one bank to pay that one payment because they own the whole thing.
And is that semi-annual payments?
It's semi-annual interest and annual principal and interest.
Oh, an annual principal.
Annual principal. That's
Okay.
correct. That's standard in the municipal market.
Got it.
The preliminary official statement, this is the primary document, and this is where I think the board has its biggest culpability, is making sure that everything that's in the official statement is true and accurate. This is governed by securities laws. And if there's anything that you guys see in the official statement that doesn't ring true, make sure you let Jason know so that we can correct it before it goes. Because this is the primary marketing document used by the underwriter to sell the certificates.
Gotcha.
Okay, and it tells everything about the bonds, the district, your history. I mean, it goes through everything, your whole water system. It has a really good description of the entire district.
Is it the equivalent then of like a private placement memorandum?
It is, or a prospectus.
Prospectus.
Yeah, it's like a prospectus. We just call it a preliminary official statement in our business. And when it becomes final, and again, you'll notice that none of the final bond information is in there because we haven't sold the bonds yet. So it's deemed to be final in its preliminary form, except for the final pricing information, which will be added after.
Got it. Okay.
Part of that is the continuing disclosure certificate. This is the requirement that Cherie is going to have to provide every year, all the information that's due to EMMA, which is the Electronic Municipal Market Access System, where you're providing annual continuing disclosure to all of your bond investors. And in addition, if a material event happens, say, for example, there was a rating downgrade of the district, there was severe disruption of service, a draw, well, there's no reserve fund, but a draw on the surety policy, or a replacement of trustee, there's a whole list of 14, 16, 17, it might be 17, they keep adding to the list. What we call a material event. So if one of those material events happens, you are required within 10 days to file a report on EMMA, telling the street about what that material event is. And that's covered, and that's a part of the official statement. You'll see that document in there. And then the certificate purchase agreement is really between the district and the underwriter Oppenheimer, where they just agree to purchase it through an arm's length transaction on the date of sale. So that when we actually finally finish the order period, we tally up all the orders, they'll make a final offer to the district to underwrite the bonds. My job is to work with Jason and Cherie to make sure that all the I's are dotted and T's are crossed. And then we give them the verbal, and that means we have a deal. And then later that afternoon, the certificate purchase agreement in its formal form with all the bond information comes out and is executed by Jason.
Very good.
So with that, I tried to address your questions, so let me know if you guys have any others.
One question, and this is for me, maybe directors and anybody listening in, is can you just, you started to outline the relationship between the parties. And can you also tell us how the sinking fund plays into that?
So the sinking fund, let's go back to that.
Yeah.
Let's
Okay.
go back 3 or 4 slides. One more. There you go. Back. Forward. There you go. So these are sinking fund payments. These are all part of a bond that matures on September 1 of 2046. However, the bondholder, say it's a Franklin Fund or Bantam, whoever buys this bond, will receive a principal payment. That's your sinking fund payment as part of the term bond. So they're going to receive that principal payment. It's just they're buying the bond in a big block.
It's not a separate reserve account that we're having to put in money over time and then it's all.
Nope.
Okay.
District will just make that payment on 9/142 of 1.365 million. And what happens is if you've got more than one fund that owns that, the trustee will choose pro rata between the funds to figure out who gets what amount. right? So that's why they claim it's a sinking fund, but you're not making extra payments or anything like that.
Okay,
Good question.
very good. Okay. Well, let me open it up to directors. Bob.
I would say the only thing I'm disappointed about is that we're only three of us here today.
Yeah.
And, this is the kind of material agenda item that you really do want to have five people here if you can possibly have. Unfortunately, from a schedule point of view, we're not able to do that here. So that's just food for thought for the next one, perhaps. But no, I don't have a lot of questions. I think you covered a lot of that. I will send a note about wanting to have an information agenda item once the documents are final. That is something we did not do the last time. And so I want to make sure that happens.
Actually, what we can do on that, Mr. Pulse, is the underwriter shortly after the sale will document the final sale, including all the comparables that we compared to as part of the pricing process. So we'll provide you that book, and that would be a good source document for that meeting.
Yeah, and that can even be on the website with a link to it. It doesn't have to be in the agenda, in the board packet,
Right.
as long as it's available on the website. But I do want to make sure we do that from a transparency point of view to our community, because this is another major borrowing event that we're
And
doing
maybe
on their behalf.
some type of a posting announcement, I don't know what,
Yeah,
that
sure.
says, hey, this information is now available. Here's what the district just did
Sure.
to take out this loan. Here's
Here's the link for.
here's the information that you're describing, Ken. Here's where it is on the district website for anybody who wants to review it. If
Yeah.
they have questions, contact our general manager.
Yeah, because
Yeah.
this gets to almost, for me, this will be the third one and almost $50 million. So that's very cool.
Yeah.
Yep.
You're good, Bob? Yep.
Just hit the targets on the numbers so that our model doesn't fall apart the first year.
Yes, I like that.
Okay. And yeah, if we could get the model back to you, that would be great, because if we're going to do one here in a couple of years,
Yes, having that basis to start from.
would be really, really fantastic. I mean, maybe we'll get the money from FEMA. And I know that we have staff working very hard in that, but I don't have a lot of faith in FEMA at this point. So,
And maybe it postpones it a year
or two, yeah.
or two,
Yeah.
but
Anyway, yeah, thank you for the great information. Appreciate it.
Mark?
the more basic questions that I had that I posed earlier this week have already been addressed during your presentation, Ken, so I'm good. Thank you. Looks good.
Okay, and Ken, I just had a couple questions from reading the documents. I noticed that unless we designate investing the funds, that it would earn no interest, and I wondered if in that same vein, can we designate, for instance, our local area investment fund
Yes.
to lay?
Yeah, as long as you're fall under the maximum limitations of what they are able to hold in lay for camp, right? Another one would be camp.
Okay.
So what'll happen is Cherie, once the transaction closes, the project fund will be at the trustee, and she can direct them based upon there's permitted investments that are listed in the documents.
Right.
And within that, they can invest it in tax exempts, they can put it in a treasury money market fund. You want to try to earn something. You just aren't able to really earn anything above the arbitrage yield on the bonds. You're not supposed to make money on it. You can for a short period, but at some point, you need to be careful of that, because within 5 years, you'll have to do an arbitrage rebate report and rebate any interest above that.
Which I think we actually did on.
And that's very common, Bob. Clearly, that's been happening to a lot of my public agencies that, they were used to earning zero for so long, right? And all of a sudden rates shot up and now they were earning all this money and they ended up getting surprised by a rebate liability.
Yeah, because I know we had a arbitrage refund we had to do, because the loans we took out were like 2 something and
Right.
we were earning interest at 4 something.
4 and 5, yeah.
Correct.
Okay.
But anyway, yeah, that's a good question, and Cherie will work with the trustee to make sure that gets.
So that
adjusted properly.
shouldn't happen.
No, it shouldn't be zero.
Yeah, it shouldn't be zero.
But the
Okay.
trustee will need direction.
Okay, all right, great. And then there was some language referring to what's allowable operating O&M, right? In that the COPs are paid out of net revenue, and net revenue is our gross revenues minus O&M. I guess from an underwriting point of view, is how what's considered maintenance? Because obviously you've heard all the things that we have to do.
Correct. So
And-
it's everything to operate the particular enterprise fund, the utility. Everything to operate that, which includes, pension costs and OPEB. But what it does not include would be mark to market of interest earnings. So if your investor portfolio, they'll do a mark to market. That's a non-cash event. That's not included. Right? It's the current amount of interest earnings would be your revenue. The current amount of your OPEB and pension expense would be liability. That would be part of your O&M.
Let me see on the maintenance thing.
Yeah.
Because to me, there's two kinds of maintenance that we're looking at.
Okay.
One is sort of lower cost maintenance. We got a pump that blows up, we got to replace. There's a
Fix.
or
Yeah.
fix.
And those are expense generally.
Yeah,
as an
and
expense.
okay,
Correct.
but when we talk about tank maintenance,
Well, that's why I'm asking.
that to me is a very different animal. That is not maintenance, that's a capital item. But we probably need to make sure that we
That's why I'm asking.
clear that.
Because there might be a gray area, and we
Right.
just want to make sure we're staying clean.
And it's usually depending on the depreciable life of the asset. So a tank's going to have a 20-year or 30. I mean, some of your tanks are older than that, right? But I mean,
Yes.
you know what I'm saying. So that would be the annual depreciation expense would be part of O&M, except it's excluded from the calculation because again, it's
Right.
a non-cash
Yeah,
item,
of course.
right?
Okay. But in this example, which was on my
Yes.
mind too,
Yes.
we are supposed to be recoding tanks, say every decade.
And those are $500,000.
Yeah, they're big items.
I would assume because the life of the tank is significant and you're increasing that life,
Yes,
that you would basically depreciate that over time.
Yes.
Right? So the depreciation expense won't count against your O&M.
See,
Oh, okay.
and see, I think we can
Okay.
use,
Yeah.
based on my understanding, we should be able to use these proceeds to do, I don't call it tank maintenance so much as, tank extending life, right? Because steel tanks will last forever as long as you maintain them properly, or
Right.
almost forever, as long as you maintain them properly. But that means doing these coatings every 30 years, 25 years, whatever, right?
Yeah. Okay, good. I think I'm just about there. Right, excluding depreciation. Okay. Okay. And I did see that prepayment options are at 10 years, right?
That's standard in the muni market.
I
Correct?
believe all of ours have been 10 years.
Very standard.
Okay.
Not that we're ever going to prepay the ones at 2 point.
No, we'll hold on to those.
Yeah, we'll hold on to those. This one, on the other hand, at 5, if we can ever get back down to 3. That would be-
Unfortunately, with the 2017 Tax Cuts and Jobs Act, you can't do it until 90 days before the 10-year date.
No, I understand.
Yeah, unfortunately.
Right.
Used to be that you could do that 3 years in or 5 years in, you'd be able to refinance it. So we will, well, I don't know, I'll be around anymore, but we'll keep an eye on it. Somebody will, right?
Oh, don't tell us that. Come on, we want to see you every year.
Yeah, yeah, exactly.
Yeah, actually, that does bring up a quick question. When you want to prepay something, it has to be 90 days prior. But is it prepayable anytime then for the remainder, or is it really just that window?
No, It's
Okay.
Any date thereafter.
Any date thereafter. Just
you
give
can't
90 days
continue.
notice.
Correct.
Right. Okay.
And we'll confirm that in documents. I'm pretty sure it's any date. Usually, sometimes it's any interest payment date, but I usually do any date, Rhea. If any date, okay, confirmed. Yeah, any date.
Super. Okay. If there are no other questions from directors? No, okay.
Out to the general
And
public.
anybody in the general public?
They'll get their hand up.
Okay. Well, that's great. And I guess I would like to move that we proceed. Oops, I don't actually have the language.
Have you had it?
Well,
Do you have it?
Or Bob?
Bob, go for it.
You-
Go for it.
I move, we adopt the resolution authorizing delivery and sale of water revenue certificates of participation, Series 2026, in a principal amount estimated to range from 16,180,000 to 17,895,000 with a not to exceed amount of 19 million to finance water system improvements and approving the related financing documents and official action.
I will second.
President Russ,
Yes.
Director Smalley,
Yes.
and Director Foltz.
Yes.
Motion's passed and the resolution will be adopted.
Okay.
Congratulations. Thank
Thank
you.
you all.
Thank you both.
Thanks.
Have a good evening.
Appreciate it.
Drive safe.
Thank you.
Thank you.
All right. All right. I think we have just. Yeah, two more. Jason, did you want to introduce?
Lisa, our
Oh,
HR
is that Lisa?
specialist down there?
Yep, there. Sorry, you are, right, of course.
I'm over
Of
here.
course, right, there you are.
Hi. Well, this is our annual reporting on Assembly Bill 2561. Last year was the first year. This is just transparency on hiring and vacancies in governmental agencies in California. And I just want to first start off with, we had much better lower vacancy rates this past year than we did in 2024. And I do want to thank the board for that, actually, for allowing us to have the interim general manager and RGS start hiring for the finance manager before we actually had the general manager in, and that definitely sped up the process when we were able to get in Shuri even before, we started the process before Jason was on. So I really do appreciate that. And I just want to say thank you for that. But overall, the numbers were better. We did have, usually we only report on budgeted the number of positions open, closed, if there's over 20% vacancy in one of the two bargaining units. We have the management, supervisory, confidential, and then we have the classified. But I did put down both, just so you could see what it looks like. And overall versus 2024 versus 2025, we had vacancy rate was 8.3% versus overall 11%, and reduced time to hire 73 days versus 120 days in 2024. So the process definitely sped along. We were able to fill the open positions in a more timely manner. And part of that also is when Jason came in, we kind of looked at the different positions, kind of readjusted, where do we need to make shifts, and we then started focusing on promoting from within the organization. Not only does that help build, overall morale and hopefully retention in the long run, it did allow us to get some of those vacancies filled and then fully staff ourselves up. We do have 2 open positions currently, but we did bring on 4 temps, and we're hoping to use those to fill as that goes. But that is very pleased with the hiring.
That's great.
It's been a lot of hiring since I've been on for the last year and a half, and I'm hoping it'll slow down, but I'm excited
And you're
to do
working
anything
yourself
we
out
need
of
to
a
do.
job?
I'm trying
Once
to.
you've hired everybody?
Absolutely. No.
Okay.
I know, but I would love to open it up to questions. If anyone has any.
I'm curious, what does the state do with these?
That's
I mean, you don't mind I ask, or is it just one of those things that we do, we have to check the box?
we have to check the box.
Okay.
It came out of what I understand it came out of, because it was just put in place last year.
Oh, okay.
So this is
okay.
only the second year we've had to report on it. And there was a lot of, confusion at first, like, what do we have to report out? I
Right.
think it'll probably streamline again. But it came out of, from what I understand, was just ensuring that agencies and just special districts and all of that, anyone, governmental agency in California was not overworking, paying too much overtime, making people do, several jobs, and putting stress on the employees. So it's just part of their transparency. We do the reporting every year, the salary reporting every year, the compensation, the government compensation, and also the LCGR. It's just, transparency. And I think that's kind of what it came out of, is just making sure not people aren't overworked. And yeah.
Okay, I mean, I was
No, I
curious.
know.
That makes sense.
Well, you know, a lot of us have that question too. So.
Okay.
Classify it as micromanagement hyper-regulation.
Absolutely. Exactly.
And if we were at a 50% turnover rate.
Yeah, maybe there's an issue.
Yeah, but even to the question of, if we were at a 50% turnover rate and we turn that into the state, would the state
No,
do? That's
No.
my
They
expectation.
would say, whoa, guys.
Or
Like, what are you doing wrong?
Yeah,
or
right.
I would like to think that this is to inform this group, the board, who are the elected officials of an agency, on what this, a
How you doing?
summary.
How we did.
Yeah, I might have in prior years, I might have had a feel of, well, gee, it seems like a lot, or it's, but having this in front of us then
Mhm.
documents it, and also then makes it available to the public to say, here's
Yeah.
so
Here's how we're doing.
I would.
Yeah.
But,
Mhm.
yeah, to deal with the regulation to get there.
yeah, I mean, it's just, look, if the board does not establish reasonable KPIs and measurable metrics that it's asking its general manager to deliver on, then that's on the board. But we don't need Sacramento
I agree,
telling us.
but we
how to do
hadn't done it
this.
before.
Well,
it's on the board.
but that's not for lack of advocacy. It was lack of action on the part of the board because they
Yes.
didn't agree with the fact that I wanted KPIs.
But,
Right?
do I have any questions on this?
I do have a,
No,
something.
I'm sorry,
Okay.
you haven't gone to us.
Yeah.
Yet for that.
No, I mean, yeah, we were just kind of working it.
Shooting at it,
So-
shooting at the regulation first.
Yeah, that's right. We all were taking shots at the
Not at
regulation.
you.
Right,
Yeah.
shooting at the regulation first. Yeah.
So Bob, you had a question, then we could.
Yeah, so this is calendar year,
Calendar year.
right? So we can't line it up with our fiscal year to actually make it more meaningful because the regulation is one size fits all and they do it in a crazy fashion.
Okay, really good point.
So, I mean, I will say, I don't know exactly how it works, whether public sector and private sector are different in this area, but I do believe that filling the position of general manager makes it easier and faster to hire people throughout the organization because they know who they're going to be working for. In my career, I never applied for a job if the position I was reporting to was open. This is a highly dangerous thing when you're in management. So I think part of our, and I want to give credit in that regard, part of it is that we have a general manager now who's providing leadership for the organization. Outside of that, thank you very much for your work on putting this together, and I guess we'll have another one in a year from now.
Absolutely. If you want to do, another one end of fiscal, we can do that as well, but you just,
Okay.
But any KPIs you want me to write up for the general manager for his review, let me know and I can help.
Yep, okay, when we talk. Mark?
The one question that I have is for you, Lisa. Does this cause you as our HR specialist to do anything different?
No, just knowing that it was coming up at the beginning of, I was working with RGS for last year's presentation, and we're all, everyone's trying to figure out what this is and what needs to be reported and, get the policy to the board to, all that. But then starting last year, it was just, we have a tracking, and it was just kind of compiling that, just making sure that I actually have put in, made sure I have the dates in there and,
Right. No,
the number of
having
meetings.
this summary information,
It's
does
nice.
this cause you to do anything different or cause you to
Oh, for
make any
me?
other recommendations? To
For other recommendations,
to your manager,
Yeah.
Jason, also.
No, I would say the things that I would look at, and I, hadn't until this was like our retention, we do have, you know, high retention. If we didn't, or if it starts to fall, then I would definitely, you know,
React.
I would have to react, like, what are the causes? What would, you know, what can we do to make that why, you know, why are we losing people? Happy to say that we, you know, we just had one person retire, not happy that he left, but you know, it was retirement. You know, so.
But I'm assuming that if you saw a drop off in that, you would actually not be waiting until
Till this came, no,
March 2027 to actually do something.
no, I would not,
Yeah, so.
no, but yeah, but knowing that we're
Okay.
reporting on it too is also, you know, keeps it top of mind, but no,
Okay,
but it's helped.
okay,
Kind
all
of.
right, thank you.
And I just have
So.
one quick question, not to put you on the hot seat, but like the IRS, you know, when you fill out Form X, they give you an estimated time it's going to take to fill it out. Do you have a guess as to how much of your time did this take?
Not too much, to be perfectly honest,
Really?
because I already
Okay.
have the spreadsheets kind of going.
Okay.
I love
Well,
my
I'm glad to hear that.
Excel.
So it's not like dozens of hours.
No,
Okay.
it was just, you know, just drafting and making sure, you know, getting. the
So
proposals
doing
and-
a fiscal year lineup wouldn't be a huge burden.
No.
Okay.
But is there a benefit
To doing
on
it.
fiscal to line it up on the fiscal year to Sherry or to Jason? Is the question that I would have.
Well, we can
Why don't
decide
we,
that a
why
little
don't,
later.
why don't we sort of let the staff sort of cogitate
Okay.
that and move on to other things after hearing from the public?
No other comments from
No.
directors here? Okay, and Scott, anybody have their hands up? No, sir. Okay. Then, thank you very much.
Thank
So appreciate the update. Okay. And,
That was a good one.
okay. All right. And, we've got renewal of the audit services.
That I'm gonna sneak out.
Yeah, great. Okay, see ya.
All right, so as you know, we are required to obtain an annual independent audit of our financial statement. We have received a proposal from BJ Brown and Company CPAs to provide audit services to us from 2026 through 2030. We have been utilizing their services since 2013. And per the California government code, it does require that we change audit partners every 6 years. We have done that since 2013, as you can see in the staff report. And they are charging the similar fees that they have been since those years. As you can see in the fiscal impact section, the proposed audit fees are a maximum of $31,000 up to $33,000 for the 5 years. But it says maximum because 8,000 of that is for a single audit. A single audit is not something that is required every year. It's basically when we spend over $1 million in federal funds. That threshold was 750,000. I did some research today and I cannot find that we've ever had to do a single audit. I know for a fact we haven't done one in the last 10 years. So that $8,000, while we have to plan for it because we might end up spending the federal fund, is not something that I believe we'll be spending over the next couple of years. So our cost would be typically around 23 to 24,000.
And
Which is-
FEMA doesn't count in that calculus?
So it depends on when you actually spend the money.
Huh.
And so the way that it works is it's by the date of, it looks at the date of the obligation versus the date of the repayment. And so the way that our FEMA funding has worked out, especially with the CCU fire, we have never gone over that $750,000 threshold. Now that they've raised that up to $1 million, I can't see us going over that. And with FEMA, there's also a Cal OES portion. That doesn't count. That's state, we're only talking federal.
Do our best to make sure that we only ever get $999,000.
On an annual basis.
Yeah, or we get a lot more than that and pay the 8,000.
Sure, yeah.
Right. Okay,
Yeah, that's all I
that's
had.
it, okay.
Yeah.
All right. Mark, do you have any questions?
My question's been answered. Thank you.
Okay. Bob?
Yeah, question and comment. So, did we get proposals from anybody else?
We did not, so my thought was me being new, Jason being new, I really wanted to keep with our same auditing services because they are a small company and I can call them up at any time, and I've done so, and say, hey, give me the history of this, because we utilized their services for so many years. So I've been able to do that, and I really think that that's gonna be beneficial for me over the next couple of years. If you wanted to say only do 3 years and then go out for RFP, I would be totally fine with that as well. I really wanted to keep them for at least the next couple of years so that they could provide me with that historical knowledge that they have.
Did what we pay CJ or FedEx and Brown was,
CJ Brown.
or, sorry, the ones before,
Brown split away from FedEx.
FedEx, yeah. So is what we paid them in 21, 22, similar in scope?
Yeah, the last 2 years we paid 23,545,
Okay.
which is actually lower than the total that they're proposing for 2026. So yeah, it's all been relative.
And that's in line with historically what we paid other firms, what you're
Yes.
saying.
That's correct.
So if I can just make a suggestion here on how to do this going forward. So under 30,000, do you need our board approval on this? Even though it's an audit firm?
Yeah, and it's I think we're looking at the whole contract, but.
Well, okay, so my suggestion here, first of all, how dare you negotiate 3,000 over? But no, my suggestion seriously is just go for without the audit. If you need to have the audit for that particular year, we don't like stacking things. That is, you don't take a 23,000 and say, we don't need board approval, and 8,000, we don't need board approval. If it goes over 30, you come back, but only come back if you need to. And that way you guys have discretion. And as long as you report to us how you just an information item, you did an RFP, and or you solicited bids, I don't care which way you do it, so that we know that you're actually doing diligence on finding the audit firm, I'd be happy with that. And you guys, it might make it easier for you guys to select something.
Right, but I'm, to your point, Bob, I'm looking at a single year that they're presenting to us at 31,000.
Well, no, but that's
But-
assuming that that audit is in there, and if you
Yes.
take that audit out, if you go
You're
and say,
The
take that
single
audit out.
report.
yeah.
Yeah.
Then it goes under 30. And again, as long as I do want to have visibility into the audit firm, but I don't need to be involved as deeply in the process for $3,000 over.
But wouldn't we be approving the whole 5-year or 3-year contract? So it's still gonna
Well,
be.
if you do that on
If they do it,
a multiple year
Yeah.
basis, yeah.
if she goes out to the same firm as she's preferring at this point, every March.
Well, what I like about this is that it's only 1.5% increase per year.
Well,
And
I'm
that's
assuming
what's
it's,
kind of attractive about
I'm
it.
assuming it's firm fixed price.
Yeah.
Right.
Yeah.
So, yeah, I mean, you can do it either way. I'm just saying
Yeah.
there is some options here if you
Yeah.
find that you can actually negotiate something individually.
So 3 years or 5 years from now or whenever it comes up.
Well, it could come up, I mean.
Yeah.
I went and read the code. You're not required to have the same person for 6 years.
No.
You can't have them more than 6 years, right? So you could choose next year, let's say they change whoever you're working with and it doesn't go as well. You could go find somebody else next year. If you want it. You're not locked into it, is my only thing. By signing up for 3 years, you are in fact locked, if that's what we're doing here, you are locking yourself in. So. does the motion say? Yeah, so you're basically asking for a 3-year approval, right? So you're locking yourself in. Okay,
I'm personally okay with that.
yeah, they're not raising fees
Yeah,
very
I
much.
mean, it's, I'm sure below inflation, so they're trying to keep us and.
Right, and they do understand that if we don't get the other extra audit, they aren't billing us for it, right? This isn't firm fixed in that regard, right? Okay.
Right.
No, they clearly indicated that on their
Yeah.
proposed fees, if needed.
Good. All right. Further board discussion? If not, anybody online? Okay. Then I'd like to move to authorize the general manager to execute an agreement with CJ Brown and Company CPAs for professional auditing services for fiscal years 2026 through 2030.
If may I, oh, sorry, yeah, you were gonna ask.
Want to amend that
Same thing, yes,
to,
for his designee.
Well, did you leave that out deliberately? That was gonna be my question.
I had,
Okay,
Oh, okay.
but we can add it in. I mean,
I'm assuming the designee would be sheriff.
true.
Right.
Yes.
Yeah, okay, let's put it back in.
Okay.
Yeah.
All
There.
right. I'll second the motion.
Okay, thank you.
President Russ,
Yes.
Director Smalley,
Yes.
and Director Holmes.
Yes.
Motion has passed.
Okay. All right. So that's it for agendized items, and I guess there are any comments from directors on the board minutes as part of the consent agenda? I'm good with it.
Nope.
All right. I don't know if we have to ask for the public. I don't, we do?
Yeah.
Okay, thank you. Anybody online?
Nobody with their hand up.
No one with a hand up. Okay. And then we have,
So we're doing this by unanimous consent, basically.
that's right. Yeah, right. Unless someone objects.
Right.
That's right. Okay. So, and I guess our final item then is district reports, financial status report for January. Right. Any comments on that? Bob?
Yeah, so just the earlier comment I made during the loan thing, that if you take a straight amortization on the numbers so far, we're coming in at 6.2 million. And we really do want to get to that 6.6 million.
6.6.
So, possible? So anyway, I probably can't answer tonight, but that 6.6 is the starting point for the plan that we put together. I mean, you know, if it's 6.55 or 6.65, it's probably not a big deal, but 5% does get you started on a bad, foot. And as we know, the compounding of that gets bigger as you go forward. The second question I had was, do we need to keep $2 million in Wells Fargo as working capital? Can we make that $500,000 and move the other $1.5 million to where it's actually earning interest?
I've already done that.
Yeah.
This is.
Right.
There we go.
This is historical because
That's
we had brought that
historical.
same issue up
Yeah.
before. Yeah.
Okay, so that's done.
So I transferred 1.3 from our Wells Fargo into LAIF, so that we can start having a little bit more in LAIF versus the Santa Cruz County Fund. Just because, as you can see, for January, LAIF was a little bit higher, so I want to diversify that a little bit. But yes, I did transfer 1.3 million.
And I'm assuming that going forward, when we start looking at our investment policy for the funds that'll come in, that we may actually end up with another line item in there, if we choose to diversify even more. Okay, well, that's really good. That takes us down to a more reasonable working capital number. Yes, thank you.
Nice job.
Yeah.
Good. Anything else, Bob?
No, oh, wait a sec. There was a note on here about a 4-month period. Is this 4 month or is it 7 months? It was on the capital project expenses. It says for the 4-month period ended January 31st. Is that 4 months?
Oh, no, that would be 7.
7, okay.
Okay.
My apologies.
And no worries, no worries. Formula. But yeah, this is good. I'm glad you put this together. Thank you.
Thank you, Bob. Any hands raised, Scott?
No, sir.
Okay, thank you very much, Sherry. Okay. Well, I think that wraps it up. No written communications, no other information. So, so I'd like to make a motion to adjourn. Are we supposed to take a vote on that?
So we are working on
The new,
that.
well, maybe, yes.
Policy, right?
Yeah.
Depends on how formal you want to be, but again, we can try doing unanimous consent, so.
Yeah, let's just do that, unless there's an objection. Yeah, we adjourn for the evening.
Yes.
Thank you.
Okay.
Thanks, everybody.